Okay, so this week's economic calendar isn't exactly packed with flashing red major releases. But honestly, do not let that fool you. Sometimes the quietest weeks on the calendar end up creating the absolute biggest moves in the entire market. Why? Well, because it's during these quiet times that the market becomes laser-focused, obsessed really, with a single overarching narrative. Where exactly is the Federal Reserve heading next? Every single piece of data we get this week is either going to reinforce or completely challenge that current interest rate narrative.
So think about this centralized policy hub we're dealing with right now. Professional traders know that in this kind of environment, raw data rarely moves price over the long term. Expectations do. We are absolutely living in a probabilistic framework. Every single node in the economy, whether it's jobs data, CPI, manufacturing, it all feeds straight back into that central hub. We aren't just looking at what the numbers mean in isolation anymore. We really need to understand how the market is actively interpreting those numbers to reprice the future.
That brings us to the crucial point, figuring out what question the market is actually trying to answer right now. The big debates of the past, does inflation even exist or is the economy slowing down, those are mostly in the rearview mirror. The governing question today, the current catalyst driving literally everything, is much more specific. Has the U.S. economy slowed enough to justify future rate cuts? That single question is the engine driving treasuries, the dollar, gold, equities, the whole shebang. Everything comes back to how investors are pricing future Fed policy.
There's a very clear line between the retail trap and the institutional edge here. Before any economic release even drops, you have to ask yourself, what is the market already expecting? Markets absolutely do not react to good numbers. They react to surprises. If the market already expects a strong headline and we actually get one, the retail trader rushes in and buys the dollar. And then they're completely stunned when it falls. Why? Because the good news was already priced in. Professional traders know the market doesn't trade reality, it trades changes in tomorrow's expectations.
Let's watch how this builds into what we call the macro chain cascade. This sequence is everything. An economic data release acts as the initial catalyst, sure, but the real magic happens in the interpretation, those shifting Fed probabilities. If the data suggests a change in policy, Treasury yields are always the first mover, period. As yields adjust, they pull the dollar index right along with them, directing currency flow. And sitting at the very end of this chain, the terminal asset, is gold. Gold doesn't react directly to the initial data, it reacts to the yield. Now, if yields are the first mover, we absolutely have to talk about the policy anchor, the U.S. 2-year Treasury yield. This is, hands down, widely considered the smartest market in the world for predicting near-term Fed behavior. It is your ultimate arbiter of truth. If you see a sudden, violent move in gold or the dollar, but the 2-year yield hasn't budged an inch, you are likely looking at a trap, just a simple liquidity spike. Confirmation always beats emotion in trading. You have to wait for the 2-year to move before you trust the flows.
Section 1. Monday. The Services Engine. So Monday brings us the ISM Services release. There's this massive retail misconception out there that ISM is just a simple measure of business activity. But the institutional reality is far more significant. The services sector represents a staggering 70% of the U.S. economy. 70%! If services remain strong, the narrative that the economy is rolling over completely dies. And if the economy isn't rolling over, well, the Fed completely loses its justification for near-term rate cuts.
So how do we actually trade this? We break down the anatomy of the release. I'm personally watching 5 specific elements. The headline number sets the baseline expectation. But then I'm digging deeper into employment as a proxy for labor and prices paid as a proxy for inflation. Finally, I'm checking for policy confirmation via the 2-year yield and flow confirmation via the dollar index. The synthesis rule here is absolutely critical. All 5 of these markets must confirm each other to signal a high probability, sustained directional move. If there are contradictions, it's just noise.
Section 2. Wednesday. FOMC minutes repricing.
Okay, the FOMC minutes. A lot of traders think the minutes are just a boring recap of the statement. They are not. The statement is totally outdated. It tells us what the Fed already decided, which is already priced in. The minutes, on the other hand, tell us exactly how difficult that decision was. Were the policymakers unanimous? Is slowing demand starting to creep into their conversations? Institutions aren't trading the headline of the minutes, they are aggressively trading the tone, because tone shifts expectations.
And this brings us straight to the FOMC mismatch matrix. We aren't just reading the document itself, we are reading the market's reaction to the document. If the minutes read hawkish, but the 2-year yield suddenly falls, we have a mismatch, and that mismatch is golden information. It tells us that hawkishness was already fully priced in, or maybe that positioning was overly short bonds. As a professional, you trade the reaction, because the reaction exposes what the market positioning looked like right before the event took place.
Because of this dynamic, you absolutely need a strict execution protocol. When the minutes drop, algorithms and funds read the exact same document simultaneously, causing immediate, violent volatility. You know that initial, crazy price spike that happens in the first few seconds? You ignore it. It's almost always a trap. Instead, you wait for the 2-year yield confirmation gate. Are Treasury yields confirming the sudden move in gold or FX? If yes, you look for a continuation trend. If no, you fade the liquidity spike. Like we said, confirmation beats emotion.
Section 3. Thursday. Testing labor resilience.
Thursday tests labor resilience with initial jobless claims. Now think back to last week. The labor market really surprised investors. So this week is all about determining if that was just a blip of noise or the start of a broader trend. Retail traders are going to obsess over whether the number is exactly 218K or 220K. Institutions, they honestly don't care about the exact number. They ask one thing: does this report completely contradict the cooling narrative? Because only a material surprise alters those Fed policy probabilities we've been tracking.
Let's actually trace a scenario using a probabilistic decision tree. Imagine initial claims jump materially above expectations. Okay, step 1, a softer labor market is confirmed. Step 2, long-term inflation pressure reduces. Step 3, the Fed's flexibility increases. Step 4, this repricing of easing probabilities pushes yields lower. Step 5, the dollar weakens because it lost that yield support. And finally, building to step 6, gold gets a serious tailwind. See, gold isn't reacting to the jobs number directly, it's riding the wave of a monetary policy shift.
Thursday also brings existing home sales, which introduces something we call the contradiction hierarchy. Housing is highly rate sensitive, so yes, it matters. But here is an ironclad rule for you. If initial jobless claims and home sales tell two completely different stories about the economy, the market and the Fed will almost always trust the labor market first. So when it comes to execution, if claims disappoint but yields refuse to break lower, do not chase gold higher. You have to let the labor narrative lead the yields.
Section 4. Friday. Revealing true positioning.
By the time Friday afternoon rolls around, the market has digested ISM, the FOMC minutes, and jobless claims. There is basically zero fresh data. And actually, that is exactly what makes Friday price action so incredibly revealing. Are funds taking profits, or are they committing? Does gold hold its post-minutes direction, or does it reverse? Friday afternoon moves, without any fresh data to drive them, tell us what institutional investors truly believe in their core, and more importantly, what exact risk they are willing to carry into the weekend.
Section 5. The weekly synthesis.
When you finally step back and look at the confidence matrix, the true picture really emerges. This week is not actually about the raw economic data. It's just not. It is entirely about confidence. Confidence in the U.S. economy, confidence in the labor market, and confidence in where the Federal Reserve goes next. The golden rule to take away from this explainer is this: trade the interpretation, not the news. The data is just a prompt. The market's pricing and interpretation is the actual play you want to be making.
Thanks so much for joining me on this explainer. Keep trading the probability safely out there and stay hyper-focused on the narrative. Remember, if a release doesn't move the needle, that initial price swing probably won't last anyway. But if expectations truly begin to shift, well, that is exactly where the most powerful trends are born. Which leaves us with the ultimate question you need to ask yourself after every single release this week. Did this data truly change the market's expectations?